Hi everyone, I'm Rick Bensignor, and this is In the Know Trader on StockCharts.com. Today is Tuesday, November 12th, and the S&P has pushed to a new all-time high above 3,100 on an intraday basis. Currently, as we record, it's at 3098, and it's up 10 points on the day, and things continue to push higher as we seemingly have some type of a renewed risk-on environment that is going across the tape. We've seen that both in the sense that equities are pushing to new highs and that yields are still having moved up where they have. The 10-year at 182. And that gives us some indication that there's less concern about some of the subjects that were very prominent just a couple months ago, such as I said last week, where are the recessionistas? We don't hear much from them at all. And with the Fed having given us some signal that they're not likely to raise the short end of the yield curve until the inflation rate holds at 2%. I think the market is a little relieved about that, and you're seeing buying come back into the market. Today on the show, we're going to take a look at the macro sectors relative to how they're doing to the S&P year to date. A quick note that a week from this Friday, on November 22nd, I'll be interviewed on Fox Business TV in the afternoon on the Charles Payne show. And then today, what we're going to do is, after we get through the normal basics, today's specific show is going to be on the top 10 weighted names in the S&P 500. Those include Microsoft, Apple, Amazon, Facebook, Berkshire Hathaway, JP Morgan. There's two classes of Google stock. I'm only going to do the Class A shares, which is GOOGL, Johnson & Johnson, Visa, and Procter & Gamble. So let's start off with looking at the comparison between where things are this week and where they were last week. And again, I highlight in either red or green dots those macro sectors that have moved more than 1% since last week, either higher or lower. And we can see there's 1, 2, 3, 4, 5 of the 11 have moved this week. On the upside, technology, which is already this year's best gainer, has added more. As of last night's close, it is outperforming the S&P by 17.25%. Last week it was only at 15.9, so we've seen further outperformance. And a lot of those names we're going to cover later today because a lot of the biggest names in the S&P are in the tech space. The other significant up move this week was in the financials arena. Again, they're getting well bid for. They're now the third best performer on the year. They are up 3.72% versus the S&P, so they picked up about 130 basis points of outperformance in the last week. Three sectors ended up doing worse by more than 1%. The continued worst place there is energy. It is now down over 15% versus only about 13.25% last week. So it got hit for almost 2%. Utilities have fallen out of grace. They were well up and outperforming this year. Months ago, they are now underperforming, and significantly so. They are now down about 4.5%. And the one that's probably made the biggest move is REITs, which are still outperforming, but only by about 1.5%. Just a week ago, they were up by just about 5% on a year relative to the S&P, and much higher than that just a couple months ago. So we've continued to see a rotation out of REITs, out of utilities, and more towards the cyclical side of the market, except for energy. But financials have definitely come back. Industrials continue to hold the bid, and they are now the second best performer. So that's a look at that. As far as how to contact me, thank you again for all the emails that we get each week after the podcast. It's rick@inthenowtrader.com to help answer your questions. And find out more information. Also, there's inthenowtrader.com, the website that I've built for information about how to subscribe to In the Know Trader and who we are and what we do, and the fact that We bring institutional level models and things that most individual investors have never seen before. We use models that institutions use, and the whole goal here is when we write our weekly report called the Tactical Trader Report, it is to align you as best we can with what institutions are doing. That's the side of the market that individual investors want to be aligned with and not opposite. And as so often is the case, they tend to be on the opposite side. So that's our goal, is to get you aligned with institutions. The other thing I want to do this week also is flip to, let's see, I think we have it here. Yeah. So there's a website that I like that's called SlickCharts.com. And besides getting the listings of all the component names and how much they represent in each stock, one of the things you can do is pull up the S&P 500 and take a look at how many of the stocks that make up the 500 stocks represent the return, or better said, the total weighting of the S&P. So here, if I just move my cursor to right here, the top 50 companies out of the 500 represent 51% of all the weighting in the S&P. And of course, this is a cap-weighted index. That's why what some people like about it, and also what some people dislike about it, is this is based on the capitalization of the company. So the biggest names carry the most weight. So the top 50 names make up a full half of how this index moves. So if you just look at those 50 names on a quote board, that's going to represent right there half of the 500 names. So essentially 10% of the names represent half of the movement in the S&P. And if we cut this down even more, let's just take a look here how much the top 10 names represent. There we go. The top 10 names represent 22.3%. So you know that the way the big cap names are trading is basically how the S&P is going to trade on any given day. So So even if you look at the names we're going to look at today, the top 10 weighted names, you get a pretty good sense of what the market's doing. And that's why I kind of like this, because it brings you back to reality in looking at, yes, there's the S&P 500 and the biggest 500 companies in the country, but no doubt that the top 50 really are the ones that sway it the most, making up 50% of the weighting. So just something that I think is interesting and worth looking at every once in a while. Let's move on to our charts. And we'll start with the S&P before we get into those 10 names. So you can see the clear breakout that we saw over about 3,030 or so, give or take. This red line along with these blue triangles here. This zone right where I've kind of got my cursor here is really kind of what we were looking for in order to increase some long exposure. We waited for it to get above 3,064. Which was a stop out level off of the weekly chart. And now we've got targets here somewhere probably around, 3120 to, I think it's, 3136. That's our next target up for the S&P. So we're certainly getting awfully close to them at this point, as the market has moved up quite a bit in the month of November. And what I have written and made very clear to institutional clients, and I'll do the same here for those of you listening to this podcast, is my belief is that the market, the S&P, will not have any material sell-off between now and year's end. And that's for a couple of reasons. Now, I'll caveat that just in the normal sense of, given everything we know and no exogenous event happening that cannot be planned for, but given the known news that investors have to work with at the present time, I think the market holds up, and kind of worst case scenario, probably in a worst case sells off 100 points from here and gets down to 3,000. and in a best case, it keeps kind of making its way higher. And there's two things at hand that have me thinking that. Number one is, and probably the foremost reason, is what I'll call benchmark chasing. The amount of portfolio managers who are considered long onlys, and if you're not familiar with what that term means, a long only fund manager is not a hedge fund. It's typically more on the mutual fund side. It is somebody who needs to be fully invested at all times, barring a little cash that they leave available for redemptions and liquidity purposes within the fund itself. But basically, these are portfolio managers that are long the market. And their only way of outperforming the S&P is to be in the right sectors at the right time. So be in the sectors that be heavily overweight those that are doing best, and be underweight the sectors that are underperforming. So for instance, this year, if you were less weighted in energy and healthcare and more weighted in technology and industrials, you probably have a better chance that you're outperforming your benchmark. The amount of portfolio managers who are ahead of the performance for the S&P this year is still relatively small, because so many came into the year defensively positioned because of last year's late fourth quarter decline. And they started off the year trailing, and the S&P, if you remember, in January flew. So by the end of January, they were already quite underneath and still mostly carrying their bearish position as far as sector allocation. And that continued through much of the year. And as time goes on, some have adjusted, but the reality is, because the market hasn't had any material decline this year, the amount of portfolio managers who are trailing benchmarks is rather high this year. And you often get that in a year that the market is up a significant amount, over 20%, like it is now. So my guess is that portfolio managers are going to need to chase performance into year's end, which means they're going to need to bid for stocks and try to do as best they can to get the return, or closer to the return, of what the S&P is going to get for the year. That, to me, keeps a bid in the market. So any sell-offs, I think, will be met with buying, and therefore I don't think we see any material decline over the next 6 weeks or so into the December 31st close. The other thing of significance that doesn't have to abide by its past history, but I like to look at history and see what happens, and this has to do with the presidential four-year cycle. And the third year of the presidency of whoever the incumbent is typically is the best for the market. So not only are we seeing a very significant up move, but, and here's the key part why I think we kind of hold bid into year's end, is that third year of historically of a president's term closes out on the high of the year. And therefore, there's just, if you look at history, it says that late December should be just about the high of the year. And so if I combine the benchmark chasing that I think needs to occur along with the third year of the presidential cycle, to me, it would suggest that this market is going to hold bid and will not see more than 100-point decline from current place between now and year's end at worst, which is just a few percent. So that's my take here. As far as upside targets, I said the next upside target is 3120 to 3136. Above that, you kind of have these areas coming together here, anywhere from 3292 up through 3336 for some time into 2020 would be the next kind of bigger upside targets. But we're bullish. We've upped tactical, and let's see, we upped tactical exposure last week for institutions, and on a pullback, if we get this pullback here anywhere from about 30.30 down to 29.80, we're going to add more to long short exposure also for those who are running long short books. So basically, I still stay bullish, and you've got a break probably under I forget the exact line in the sand that we came up with, but it's somewhere around 29.50 or so to 29.30 is my line in the sand. And as long as we stay above that, I'm cool on being long and having long exposure in the market. Okay, let's move now to our charts. Well, actually, let's move this to Microsoft, and we'll take these in cap order. So we're going to look at weekly charts by default here, unless we need to look at something else. So here's a long-term chart going back let's say 4 years in Microsoft. You can see there have been multiple sequential 13 signals indicating exhaustion of trend along the way. Some have been good, some have not been. I'd say the ones here in 2018, this was, here, we'll add an ellipse. Let's see. This and this, these two were very good, and you got the pullback, and notice you pulled back right to the cloud, turned around and have continued on the upside here, and even today we're, or this week, we're making all-time highs. We are right now up against the stop out level from these 13s, which means I'm not going to be a buyer right here and right now in Microsoft. I'd at least wait for a little minor pullback. It may only be a few dollars. But as of right now, it looks like that I'm, up against a risk level from the sequential model. I'm generally not buying. Higher targets here, look at 153 to 156 is next level. Let me take a look here quickly at a monthly. Get anything from there? No, we've gone through just about everything there is to take a look at. So to me, at this point, it's just a matter of looking at when to get into the name on a long-term chart here. So look at the monthly and look at this kind of pinkish colored line from the cloud chart. Barring one move in here in early December of last year, right? You've held above this line, and every time you pull back to the line or even anything close to it, it's been a buy. So right now that's at 128, that's $20 lower. This will keep moving up each month for the next several months. And so that's one way of looking. We can go back to the weekly chart, and I'd say if you believe in the bullish scenario for the market over time, then anywhere from 140 to even 133 right now would be your place. And again, pay attention, use the cloud chart and look at the conversion and baselines as we go forward over the following weeks, and that'll give you a clue as to where you might want to get into Microsoft. Apple, also making new all-time highs. Of note here, for those of you who are cloud followers, even though price broke underneath the cloud in fourth quarter of last year, notice the lagging line did not break underneath its cloud on the lows where we got a setup 9 count, and that helped define the bottom there at about 150 or so. The stock is now trading over 260, so it's had a dramatic move this year. In fact, if you take a look at, this is here, the December 31st was 148. So the stock has almost doubled this year and continues to look like it's got room to go. The only other target I even have above all-time highs is up at 286, still $25 or so away from here. And again, if you're looking for a pullback somewhere around 240 or so, not a bad place to take a look at it, especially given that the old highs were at 233. So somewhere into the 230s and low 240s is a place you could look for to do some buying. Amazon. Why am I not getting? Here we go. Okay. So unlike the first two names we've looked at, Amazon actually is not on its highs and is showing technical resistance. So if you look into 2018, the first time it made a high was at 2050, came back and tested that at 2033. earlier this year got to 1950, but more recently got to 2020. So anywhere from about 2020 up to 2050 is resistance in the name. And the question becomes, is this going to move higher or lower? Can it break to new highs? If it does, you're talking $2,413 as the next upside target if we can break through 2050. More important to me is looking at what's going on here in the cloud model. And the cloud model combined with this line here at 1586 is going to be the most important levels to look at. So as long as we stay, I'll use this as the line in the sand for Amazon. You stay above 1586, the stock's okay. Notice that recently the lows have been right at where the cloud is. So over the summer and into early fall, September, the low here at 1685 is basically the same place that the cloud is. The low here, 1695, is just where the top of the cloud was. So it's still struggling. It needs to trade up and really through all-time highs. But if you have the name, it's a hold. Where I start getting concerned is if you take out this low here on Friday closes. Beneath 1586 potentially opens the door to retest those Christmas lows down here at 1292 as the target. What could make that happen? In and of itself as a company, I don't think it would likely do that. So you need a significant market decline, or you'd probably need a progressive Democrat to come in, and that's that's a full year away, and then start trying to do something with some of these big companies. So Bernie Sanders and Elizabeth Warren, somebody who has talked about potentially breaking up big tech, that's where the problem could come in. Otherwise, in and of itself, I think the stock's okay. And again, I'm just kind of using this 1586 level as a key level to look at. Facebook. Here we go. Facebook recently had a sequential 13, indicating exhaustion of trend. It's gone sideways since. So it got as high as, looks like 219 or so is all-time highs. Down here at 195. Let's see if there's anything that I can really make heads or tails from. As far as on this weekly chart, I don't really have, looking here, a place. So in the next few weeks, if we test back down to 185-ish, that'll kind of be the important level. So even though we've traded beneath that recently, I would say going forward, somewhere around 185 is important. If you long the name, you stay long the name. If it breaks 185 on Friday closes, I'd probably lighten up somewhat. Wouldn't get out of the whole position, but it would give me these multiple tops here, plus the 13 signal indicating exhaustion of trend, to at least make me think that it can get back down towards this part of the range. So back in June, we got down to 160. I would think getting Friday closes under 185 opens the door for it to retest down to that level. Berkshire Hathaway. So let's take a look here. All-time high, looks like it's right here. So we're getting close to all-time highs. Last week got very close to it. This week we're hanging in. Breaking above it would first target 232-ish and then 245-ish. Those are the initial upside targets. This has not partaken as well as some of the other financial names we know that have really burst to new all-time highs. Nonetheless, and by the way, here the cloud chart, the lagging line in bold blue has always stayed above its cloud, so that's good. Even though price broke beneath, the lagging line stayed above. That's kind of bullish and keeps this in bullish structural form. So I'd actually look for this to probably break to new highs and quickly scoot up to 232. On the downside, unless we get multiple Friday closes beneath 213.88, I'm content in holding the name. JP Morgan. Multiple 13s over the last couple of years. Most of them were spot on. This 13 here had a decline for almost half a year. These 13s here had a decline for almost the other half of the year. Then we had a 13 in May this year, sold off straight for a month before coming back, just to put in another 13 to sell down. This too, basically the cloud, other than this one close here, which is reflected in the lagging line right here, this has been and stayed above its cloud for years too. So we've got another 13 here. The 13s in the past have told us that it's not usually a good time to buy JP Morgan. So given that it came in a couple weeks ago and the risk level is 132.74, you'd have to get above 132.74 in a couple Fridays closes before I'd be willing to buy that much into strength. Otherwise, I'd look to buy on a pullback from 125 to, let's say, 120. Google, and again, we're going to look at the Class A shares, which is GOOGL as compared to GOOG, which is also one of the top 10 most capitalized tickers. But considering they're all the same stock, let's just look at one of them. They're going to be close enough. Same thing here. Sell-offs broke the cloud. The lagging line never broke its cloud. That's bullish. The 9 count here in July, so that's 9 weeks in a row, just to review, 9 weeks in a row that the closing price was less than the close from 4 Fridays prior. When you do that 9 times in a row, you often have a turn in the market. This has, and it's now above the, what do we have here? So this has been all-time highs. We're pushed above. We're not progressing much, but it would say here that 1346 is the next target up. Support should be near 1250. If you're long the name, stay long the name. I'm not worried unless we get under 1250. We've got a minute to go. We've got a couple names left. Let's look at J&J. Sorry. My terminal defaults to futures tickers, so J&J and futures is different than J&J, the stock. So here's the stock. Again, obviously not in the tech space, obviously a company that's had multiple negative headlines across 2019 because of the talc and the baby powder. So, you know, the stock's really kind of done nothing. If you look at where the year started and where we are now, it's virtually the same. So minimal price movement here of significance over the course of the year. And frankly, it's a flat looking stock. I have no particular reason to play it. There's just better names to play than it. Visa, as this has been one of the stellar names. Look at what this has done in 2019, way outperforming most other financial names, which only recently started really trading up. Stock looks good. Only if we break under 171 on Friday closes do I have a little concern. Otherwise, I'm cool with things in this name and can look for higher levels over time. And very quickly, Procter & Gamble. Hold on. There we go. So also trading well up, well above its cloud. If I bring in more data, right? So all-time highs. As long as we're above 113-ish, I'm okay. Friday closes under 113. Get me a little more concerned. On the upside, look for 130 or so from the current 120-ish level. That's it for this week. And thank you for